We're going to do First Republic Bank, FRC. And I wanted to mention I do have a previous episode that this is somewhat attached to, and I've linked that in my show notes. So if you need to look at that, that one goes through the quarter and what happened on the quarter. But because this thing has been trading so crazy, I'm going to do something I don't usually do, which is do a follow-up. That's the YouTube channel background. That's why I can't have it on. Anyways, so let's get into First Republic Bank. Past performance is not indicative of future returns. I have strangles on it right now, I think. I might have some long stock as well because of the way the options were trading. I wanted a little bit more to hedge if I was going to do more tomorrow. So that's my positioning on it. And now let me go into what I have prepared. And I usually really hate picking on anyone, but I'm going to use this article from the Wall Street Journal as a foil to kind of give some structure to this. And I want to say this in advance. I didn't put their names on here because I'm not trying to throw shade. I know how hard it is to come up with content every day, especially if you're not, old or so to speak. And especially the banks, it's taken me all of my entire career to really appreciate and understand bank financials. So I kind of get it if you're just a journalist with a little bit of accounting background and you're trying to go through the financials, it would actually be kind of hard. So as you know from the previous episode, I did try to spend a little bit more time going line by line on how you would think about interpreting those things, and I'll do it again here. There were really two things in the article that I kind of wasn't stoked about in the way that it's spun, in the way it's described. And the two things were these two things right here. The first sentence that said those unrealized losses are still significant and make it difficult to find a buyer for the. I'm going to demonstrate why that's wrong. It is difficult to find a buyer for this bank, but it's not because of the losses, and it'll be really clear hopefully by the end of this. And if not, y'all just put it in the comments and hopefully it feeds through and I can see your comment before I end this session. The second thing is this comment where they just literally quoted this MD. I don't know Janie Montgomery Scott. I'm sure there's a lot of really great research out there. My suspicion is this is out of context because, and I'll just address that one first. They've never been a super profitable bank. I don't know why they're feeling that way. Okay, just let's address the second one first, and then I'll get into the rest of it. The second thing first is this. This is their total return, shareholder return stats that I pulled straight from their 10K. All right. And this was in their presentation deck, and they literally show it every single time. And you can see that it is plenty profitable, with all due respect, at least to shareholders. It's plenty profitable because they do issue a dividend. They have a preferred stock. It's not it won't necessarily change that much if you're doing a variety of book value calculations. But there's nothing wrong with the returns of this bank. If anything, if you had asked me before December, hey, May, what are the best regional banks as far as returns go and stability and all that stuff? I probably would have named First Republic, and to a lesser extent, I would have named Silicon Valley, only because I was worried about the venture world. But I have no idea why that has to be out of context. The context it might be in might be that they were just suggesting, hey, regional banks in general are not tech companies. They're not trying to slam it out of the park, so to speak. Silicon Valley Bank, however, every earnings season that you would have looked at did actually look like a tech company. So it's a little bit of a different animal. Additionally, Silicon Valley Bank made a lot of money off of their warrants, which is why the returns look the way they did. That's not First Republic's business. They're quite a bit more conservative than that. So that hopefully addressed the first reason why I'm teasing that article a bit and being a little rough on those guys. But let's actually go through again. So clearly that thing's been trading crazy since its reported earnings, and I'm sure that everybody out there is worried. Is this thing going bankrupt, and how do I think about it? Okay. And the first thing that I would say is that if you are with this bank, it is a low probability that you don't get your deposit back. And the reason for that is because they were very clear on the call how much exactly they had reserved for it, which is more than enough. This was from the last call. 19.8 billion uninsured deposits, but the bank has 45.1 billion in cash and cash equivalents. 13 billion of that is cash, and then the cash equivalents really is everything else. So realizing that, you will get your cash back. So there's no reason necessarily to take the money out. Now, the mix of business that they do might make you feel a different way, but nonetheless, this really is a bank run. And I just want to show this very clearly. I'll show you very clearly in a bit, but let's get down to some of the basics again. I went through this last time. The other thing that you're going to look at for profitability, which is why I thought it was a little bit crazy sauce, is that, yes, if you look at the recent quarter, return on common equities, which you probably look at for profitability, or you could look at earnings, and you'll see approximately, well, you see something that's a little bit different, but it'll still be in the range, okay? But return on common equity was down significantly on the quarter, 6.65%. That was 100% due to funding cost. If you need that, go back to my last video. I walk through it all, right? But the more important metric, or the equally as important metric right this minute, is price to book value. And the reason price to book value matters is because that book value is just total assets minus total liabilities, adjusted for very baby hair by the preferred stock, which is why when you do that calculation, book value is the same whether you take out the preferreds or not. Okay, so you can buy the bank at 20% of book value. What does that actually mean? And this is what drove me a little crazy about the article. Okay, couple steps to understanding what does that actually mean. You are going to actually have to take your assets, subtract it from the liabilities, which is unfortunately mostly deposits, but we'll get to that. Remembering that a lot of those deposits are FDIC insured, and then you'll end up with total equity. Then you look at what the share, what's actually trading on it, and that's how you end up with understanding that's kind of, well, I'll go into it a little deeper, because it really has to do, the book value is the piece that you care about if you really truly believe that you can't find a buyer. So I'm going to go through why the book value is what it is and what it would imply to a buyer, and why I'm therefore a little bit upset with that statement from the Wall Street Journal, namely the unrealized losses are significant and make it difficult to find a bank buyer. Okay, buyer of the bank. All right, here are the three possible options. And this one is part of the reason why I actually care to watch First Republic to begin with. The first option is the Fed takes them over. Okay. The second is an asset sale. And the third is that they sell First Republic Bank outright, which I personally would prefer them do. And this is why. In all three cases, the depositors are fine. In the last case, the depositor ends up at a bank that they may or may not want to be at. So that is what it is. Okay. The equity holder, in the case that the Fed takes them over, you get nothing. All right. The asset sale is the stock value will be adjusted for it, but guess what? At 20% of book, it's already adjusted for. And then the problem is that during this whole period of time, if they just do the asset sale, then the shorts and the meme stock people and whoever else can sit there and try to make everyone believe that the bank is going out of business by attacking its common equity, attacking its public equity. Okay. So in doing that, you'll sit there, the stock will languish. You don't eliminate the risk of people being worried that they need to go to another bank. And so that is not ideal, in my opinion. That's the wrong solution, in my opinion, but I don't get a say. I'm just May. All right. So in case they sell First Republic Bank, it depends on the deal that's struck, but mostly the equity holders should be in a better place. I mean, it could be that the Fed goes whack-a-mole and just decides to sell it at that massive discount. It could be a stock purchase, so that it does nothing to the cash situation, except it basically absorbs into someone else that has more cash. A little bit more like Credit Suisse in that case, right? It could be, but Credit Suisse had real impairment. This bank does not have real impairment. We're going to go through that. And then it could be that it just gets bought in at some kind of discount above 20% of book, and we'll talk about that. For First Republic, if the Fed takes them over, that becomes a big zero. On an asset sale, it depends on the equity valuation, but you don't really change anything about the fragility of the bank. And if you sell FRC outright, everybody wins. Taxpayer, if the Fed takes them over, we're going to get a big bill. Okay. And if you think we don't get a big bill because the newspapers keep writing it like it's the other banks that will be paying that bill, then that shows a lack of understanding of how money flows through the system. We will ultimately be getting that bill as the taxpayer or as general people who use banks. Okay. So we will suffer, not the banks will suffer, not other people will suffer, because the banks are just going to pass that right on through to us, by the way. Okay. So that's the first thing. We lose if the Fed takes them over. The only group that potentially wins, and I should have added that, is also if the Fed takes them over, all we did was increase systemic fragility. And I'm going to argue that case pretty aggressively too, because of the nature of what First Republic actually was. If the Fed has to take them over in order to save them, it argues that every regional bank and even some of the larger banks, depending on how much capital is coming at them to attack them, are at risk. Okay. And then the only winner on that, if the Fed takes them over, is private equity, to the extent that private equity gets to buy those assets on the extreme cheap. Okay. In an asset sale, since it doesn't solve the systemic fragility issue, all it really does is delay and provide more time to get a buyer of the stock of the company altogether. Okay. And then private debt buyers are the winners, again, in the asset sale. But if you sell First Republic, then number one, you actually make progress on the systemic risk issue, because you enter in some other players that are not, I believe, currently being considered as these banks continue to experience with their experience. Additionally, the buyer does actually still win, and we're going to talk about why the buyer would want it. And there's no taxpayer issue. Okay, we get to save the taxpayers' money by not putting more risk into the system that the FDIC is then going to need need the banking system to pay. And also, we don't have to figure out a way to deal with the assets of First Republic. Okay, so then what's in it for the buyer? Okay, first, let's talk about the income statement. I just want to show this really quick because a lot of folks today were talking about cost of capital, la, la, la. Okay, the cost of capital is happening from the fact that this bank used to fund itself on deposits, and then now it's funding it on a particular type of deposit where it also owes cash on it and borrowings. That was not the case before. I would reference you to the previous video. Additionally, you can look at the December First Republic deck. It'll show clean as day exactly what its funding cost was, which is about 96 basis points before all this mess, and then Silicon Valley, and now its funding cost is not 96 basis points, okay? The Fed borrowings that it has from December were about 380 basis points. Sorry, if I'm using the term basis points and you don't know what I mean, basis points is a percent. Is 100th of a percent. So 386 basis points is 3.86%. 90 basis points is less than 1%, 0.9%. Okay. So the funding cost, that was what the funding cost looked like before. That's not what the funding cost is now. And the reason that's not what the funding cost is now is because of this. It's because the deposits shrank aggressively, 100 billion on the quarter. Okay. So what would be in it for the buyer? Like when people talk about it's hard to find a buyer, it's not because of any held to maturity losses. And this is really, when somebody says that, I want to take them aside and be like, did you go through the balance sheet? And if so, what are you seeing that I'm not seeing? This is the balance sheet for the bank. Okay. And when you look at the balance sheet, first of all, it's a regional bank. So it didn't have any crazy exogenous risk. And by definition of being a regional bank, it shouldn't have FX exposure in any kind of meaningful way. Okay. If it does, it's got to be some random one-off, but definitely, given all of the detail, all the documentation that they've given for themselves for the last 23 years, they do not have really crazy stuff on this book. This book is a very straightforward regional bank book. So it's 172 billion in loans, 13 billion in cash that you're getting for $2 billion. $4 billion in life insurance, 1.3 billion in tax credits, and 6.3 billion in other investments. These are just not traditional loan type investments. You would need to, on the other side, also be able to either somehow support this 104 billion in deposits. This is what makes it hard. 104 billion in deposits, and you need to pay back that 100 billion in loans. Okay. But the loans are done cheaply. And also, your lender for most of it is the Fed, who is very incentivized to help you out. Okay. So that's what you'd have to come up with. Not the issue. The $22 billion in mark goes off against this 172 and it goes off against the assets. That's a big fat nothing, especially since that's a paper mark. That is not an actual like loss that's being taken. And the reason that we know that that's not a loss that's being taken, we're very close to my kitchen, so you can hear my Soji Roshi. The reason we know that that is not a loss to be taken is because this is their loan loss experience for the entire history of this century. Okay, since 2000 to 2022, First Republic's total net charge-offs average only 3 basis points per year, 0.03%. That's what their charge-offs have been on average for the entirety since 2000. Okay, that is crazy low. They show you above that the average bank's net charge-off is 33 basis points. And this quarter, it ticked up just a baby hair to 6 basis points, 0.06%. But that is definitely nothing to be worried about. And the reason it's nothing to be worried about is that what happens is when they do the charge-off, oftentimes, especially when they look like this, they're doing the charge-off and then they get to either sell the loan or sell the assets, either one. Now, given the mix of what most of this book is, it is mostly single family residential from rich people. It's mostly this. Okay. So what happens, and I want to show this to you, even though you may not be able to see it clearly. If you look at this, you'll see some instances where the green line is negative. It's below the line. And that's not a charge off. That's actually a gain on sale of the asset that they thought was deficient in some ways. How does that happen? The way that happens is you went ahead and took back the loan, right? Because that guy declared bankruptcy. So you took possession of their house and then you sold their house at a higher price. And that, so a lot of times when a bank like this does charge-offs, knowing that most of it is residential, if the equity, if the actual price of the value of the asset increases when they finally go to sell the asset that they've repossessed, you could actually see that come straight back. So when we're talking about this, which is what would it take for someone to buy in First Republic Bank, and I get a little bit incensed by it because right now the market cap is $2 billion. So you take all of First Republic in for the $2 billion plus whatever you can do as relates to the debt. The reason there's a little bit of crazy pants to it is that first of all, the assets of a bank are the loans themselves, which have to take a little bit of a haircut, 20% haircut. I get it. Okay. They've got $100 billion in debt, but here's the thing. If they actually get any kind, if the buyer is able to stabilize the deposits and even increase the deposits, that $100 billion goes away really fast. Okay. And then the third thing is that there's no loss on the loans. Okay. If there was impairment and loss on loans, that'd be another thing. But especially if you're an entity that buys them and already has a bank with enough capital and no place to put it, then you can literally go ahead and get rid of these loans right away and do nothing. And then you get this whole book of loans with 0%, that is extremely high credit quality. And again, like I said, there's no charge-offs, 23 years, we're in 2023, 23 years, almost no charge-offs, right? That's really what it said. So you get all that for $2 billion, which is $17 billion worth of equity value. Okay. That's what, if you take the assets and subtract the liabilities, right now you get a $17 billion number, provided the deposits don't exit. You get that for $2 billion, but you have to be able to support the deposits somehow and also manage the financing component of it. All right, what else? Now, let's actually talk a little bit more about the loans, just in case some of you actually are watching this and have $100 billion or way to get $100 billion. Let's just be complete and contextual. This is their loan geography, okay? It's really 3 markets, Boston, LA, and New York. So to the extent that those recoveries do well, then that's a fantastic thing. What is the mix of loans? It's 61% single family residential. That's what SFR stands for. And equity lines of credit on that SFR, on the single family home. So if in the 3 markets that I just showed you, if you believe that in those 3 markets, home prices increase, not decrease, since most of these are, and I'll show you the loan. There's one other slide here, I think, that goes through the loan. Oh, here we go. This is the past 2 years of origination. Okay. So if you believe that home prices increased, then there's no reason you should be concerned at all about those loans. Okay. So the past 2 years, and also these are jumbo loans, but here's your average loan to value that they required in order to write you the loan. 60% if it was single family residential, 55 if you had a duplex or townhome thing because you were doing that kind of commercial. And then on true CRE office type stuff, this would have only been $2 million, or sorry, the average size loan for this commercial type, which could be office, it could be warehousing, it could be medical, it could be whatever, that's going to still have 46% loan to value. Okay. So given all of that, that's what would have to happen for this loan portfolio, which is currently 17 billion, for the cost of 2 billion to be a bad deal. All right. What else? Oh yeah. So actually, this is the mix of loans again. So that's the single family, multifamily I went through, and commercial real estate. And then you're left with, sorry, it's over here. Single family, multifamily, commercial. And then you're left with this last mess of things, which is about 20% of the book. 20% of the book is from December, this mix. Now we know, because of Silicon Valley Bank, that the private equity piece increased. So it probably went, let's just say it went from 57% to 70% of the final piece. Then that is venture private equity. But realize that they got to vet it very quickly, but they still got to vet it before they brought it in-house. So that piece may be a minor risk. But again, if you could stabilize these deposits, then you're still getting 17 billion extra cushion at the price of $2 billion. And also, you got to have a company that can actually take care of the other parts of the balance sheet there. So Juicy got you crazy. Here's the thing. Now, I think that's all I have prepared. Let me just see. Yeah, that's all I have prepared for this. Hopefully that made sense of things, because it is, again, 2 billion for the price of 17, but every day, or to the extent that these deposits flood out, that can be an issue. Now, if nothing happens to the deposits, despite today's activity in the stock, then that also could be a really positive sign for the stock, because like I said, this thing is trading really cheap, given that it doesn't have credit losses. Now, I do want to say this, Juicy got you crazy. No tier for the rich people bank. I understand what you're saying there. Okay. I feel you on that, because I definitely said this is the rich people bank. But here's the thing. If the Fed cannot defend a bank that has 0% credit losses, and also has a very regionalized, very specific set of areas that are known to actually retain their value, I don't know what the Fed can defend. So I kind of need the Fed to demonstrate to me that they can defend this bank, right? I mean, if it was toxic assets, that would be another thing. There's no toxic assets here, okay? Just like, and then, okay, I think you got me on that. Do I think it's headed to zero going back up? It's too hard to tell too, Brando Doe. But I do want to, it's too hard to say. But if this one goes under, it's not because of credit losses. It's not because they did something crazy on the management of the bank. It's none of that. I mean, every single time a bank goes, people made up stuff about Silicon Valley Bank that I completely wholeheartedly disagree with. Nonetheless, here we are, and no one will ever really know the truth. But I don't agree. What I think is actually happening for a lot of people is this is the first time they're looking at a bank balance sheet. They're taking the snapshot that they looked at and not realizing that when all that stuff was done a year ago, 2 years ago, that the deposits did a set of activities that has changed dramatically. And it's changed dramatically, by the way, only because this increase is unprecedented. The rate increase is steeper. And I mean, the speed, it's the speed and velocity of the rate increase. It's not just the rate increase itself. What that does for the ability of a bank to navigate is crazy. Okay. Because everybody acts like, oh, why can't they just do this? It's not a hedge fund, guys. It's not structured to do certain things. And also by law, it can't do certain things. So it's a little like the investment banks even can do more. So like a JP Morgan attached to an investment bank, it has the ability to do way more. That's part of what the treasury function. Regional bank isn't structured to do that. Okay. So it's a little frustrating when people say that. Also, I don't have it here. There were a couple of threads that were going on about federal deposit insurance and how a bunch of like hundreds of banks went bust in 2007 versus 2008. And that's just wrong, is what I have to say. Exactly 3 FDIC insured banks went bankrupt in 2007. Bear Stearns blew up in March of 2008. Only 2 more banks blew up after that, and none of them were this size. Well, I mean, maybe one of them was approximately the size. I have to double check. But the other thing that's really relevant when people say that kind of nonsense, and I'm just going to say it like it is, sorry if I'm triggering anybody, it is nonsense. But the reason it's nonsense is those banks went under because of credit issues. The mortgage markets, which were written incorrectly, the mortgage originations did not match the losses that were actually happening. That's what it means for you to poorly originate a loan. The interest rate that you gave that person had nothing to do with their ability to pay it back. If First Republic goes under, it's very different because these people will pay you back. They're a bunch of rich people that have no problems paying you back. Okay. And plus, even if they weren't a bunch of rich people, it's 60%, 40 to 60% loan to value. Okay. So 40 to 60% loan to value, especially since most of that is residential. And we've had housing prices go like this, means that even if you took it back, you'd sell the house at more. It's ridiculous. So there we go on that. So, but nonetheless, what we learned in the 1800s, by the way, is that it doesn't take much. If you do a run on a bank properly, it doesn't matter what the bank has. You can take it to zero, no problem. You could privatize the bank, and that is a real thing, okay? Privatizing the bank could mean that the equity shareholder, privatizing the bank is a longer story, but if you privatize the bank, you could take it away from the public equity markets. You would still need to come up with something greater than the $2 billion in capital to take all the shares private. This would be like Twitter. Essentially, you have a Twitter scenario, and you'd need a lot of capital, and that capital would basically have to pay the Fed back the $100 billion, and then you'd have to have the right sort of buyers. So private equity wouldn't do it. You'd have to have the right sort of buyers, and also technically, you'd want to do it within something that's already a bank holding company, because you're gonna have to unwind the bank in different pieces. So it's not the most straightforward thing. That is true. An asset manager like a BlackRock does have a bank holding company, but they would be unlikely to do it because they would gain a few regulators over and above what they already have and be subject to a couple of things that they probably don't want to do. So there is that. So technically a BlackRock could do something like that, but I don't think they want the implications to the rest of the business on the asset management side. So this is better done. One of the ways that you would have to do it, I think, and my background is not private equity, by the way, nor is it investment banking, but I was trying to figure out how you might do it. If there was some really tiny bank holding company that you happen to have enough capital to buy, and you bought that on the cheap, and then you got a bunch of financing because you believe that for $2 billion, you could get $17 billion versus worth of stabilized equity, that might do it. But I'm not for sure. You really need to talk to an investment banker that specifically works in financing banks. Okay, that's what you would need, and they'd have to probably be pretty smart. Now, Warren Buffett could do it because he got $100 billion, right? Plus, he's got more than one bank, so he's not going to have any kind of problem managing the regulators. And there's any number of things that he could do on top of it. This is a stale statistic. Argos read. This is not true. It's 97% is what they got at the very end of. You want to take a look at my other video, and I'll clarify it there for you. Let me see if I have it in here. By the end of the quarter, it was 27%. Uninsured deposits is only 19.8 billion at this point, and then the rest of it, they have lines of credit to pay it off. So this is incorrect. It's not almost 70% of First Republic. That's not correct at this point. That was correct, however, if you go to previous quarters. Let's see. So if their books aren't bad, then why? Their books are, okay, this has 100% to do with what a run-on bank is. Let me show you very clearly, because this is what a lot of people get wrong. When you look, if you take any given snapshot of these banks, right? And you look very closely here at deposits. Deposits typically forms the bulk of funding. So if you look back last year, you had 162 billion in deposits and 3.7 billion in loans. And that was how the bank funded itself. Total assets of 187, total liabilities of 170. Okay. And essentially, all you have to do, all anyone has to do to get a bank to go bankrupt, or not bankrupt, to get a bank to become defunct. Let's say it that way. This is what a run-on bank is. All you have to do is figure out a way to get those people with the deposits to decide to leave. Because when those people decide to leave, the bank becomes out of sync with what is required to hold in cash in deposits, period. Okay? Because basically that cash comes out of the bank and they have to come up with another way to fund themselves. And the reason that they become out of sync with regulation, ironically, is arbitrary. Because believe it or not, China does not do this, but they have a different way of dealing with this. So we have this thing called Tier 1 capital ratio requirements, okay? And then there's a bunch of other risk-weighted requirements and stuff like that. The number for the regional banks is, I think it's 6 or 8, depending on the size of you. Okay. And as soon as you don't have that, the Fed freaks out and all this other stuff. Okay. And then you get fined and it becomes significantly more expensive for you to run your business. So all you have to do to take any bank out is get their depositors to run for the door. Now, it turns out that it used to be great for your depositors to be wealthy people, but and they had this slide in their December deck, 1 in 5, we have 1/5 the number of customers. And then they have another statistic about how little that was for the assets that they hold. So the problem with that is actually called correlation of deposits to, a number of things, not the least of which is your loans. But that's a totally different risk that isn't talked about very much. I get it. It's fine. It is what it is that you don't talk about it. Sorry, but nonetheless, there it is. So it doesn't take as many depositors to leave for you to have a big, huge issue because the size of the deposit that they had was so great. Now, I think that the depositors of First Republic did the smart thing, which is they left their money with First Republic and then they used First Republic to buy things like, treasuries or something, but kept it custodied at First Republic so it didn't impair them. Because here's the thing, if First Republic goes under, your option as a rich person is kind of limited too. You could go to another regional bank that doesn't have as good service, right? You could go to a big bank that definitely doesn't have good service and also has all these other special things that weren't as good as First Republic. So you kind of like that they stay there, quite frankly, is the way that I'm thinking about it. But rich people like to also keep their money, so they don't, let's see how it goes. You're so funny. I said rich people, but y'all heard something else. I like it. Toxic enough to fail. No, actually, toxic assets is a very specific term that has to do with credit loss. So they don't have any credit losses. If they fail, it's a pure bank run. Do I think it's, let's see what else we got. Do I think this will, I don't know. This Fed is doing all kinds of crazy things. And this market has gotten more political than, in my opinion, it has been in past periods of history. But perhaps I was younger and more naive at that time. I've been doing this for about 2.5 decades. So you can, and I've been naive before, I won't lie. Do you know what I'm saying? So it's hard to say, but boy, does it seem like this market has gotten more political. Look, if you've also been doing this for a long time, stick in the comments. I'd love to know if you feel like this market has gotten a lot more political than it has in the past. And that's despite the Fed, in my opinion, trying very hard to hold the line wherever it can. I don't know about the Treasury so much, but definitely the Fed tries. And let's see, what other questions do I have? The credit crunch got them. You mentioned that rates went up high for them to deal. Yeah. It's not exactly in your base. It's not exactly a credit crunch per se. Let me see. I think they have it. Let me see if I have their slide deck. I'll show it to you. It's really this. I'll try to explain it best I can. And some of this is just, there's so much jargon and it just takes time to let it all kind of sink and get into your mind. I just have time on this over other people. And then there's a bunch of other people that have even more time with it and therefore know it better and explain it better. Here, let me share this and hopefully this will clarify it. Just so you can get a sense for how steep that curve was. Okay, this was actually from their December deck. Okay, this is the green line here to the left is how fast and steep the current cycle's increase was. And what that does is it doesn't give you time to really do very much as a bank. In some cases, you're just not allowed to hedge that way, period. In other cases, you're like, well, the yield curve is humped, and that's kind of a thing. So there's that. So this really is a very aggressive ask of any bank to quickly do. Is a little bit easier if you happen to be investment bank. So Jamie Dimon telling everybody, hey, you shouldn't have any loans on your balance sheet is special. But he is smarter than me. He's been alive for longer than me. So maybe he's got a particular vision that I just couldn't possibly have. I'll give it to him, especially given that the two things I just said were very true. But this is what it is. And this is very hard for management to quickly navigate towards, especially if the back end of the curve looks a particular way. All right. So they would most likely, since those are 30-year fixed, they probably tried to match the back a particular way. But this middle part is what's causing a little bit of an issue. That's why humped is a problem. Because humped would make a lot of economists feel very strongly that rates are going down at some point after this period of weirdness and inflation. And therefore, you would do your calculations one way, but inverted, which is what we started to experience, unfortunately, makes you do something different. So each one of these is not, inverted means that you're basically interested in having liquidity today versus tomorrow. That was that little post I did about Wimpy and the burger, right? I'd gladly pay you Tuesday for hamburger today. I'd gladly pay you Tuesday for liquidity today. That's what inverted means. Right now, we're getting closer, but it's still kind of, By the way, in 2008, if you guys look back at any animated chart, you could see the curve actually did go inverted as an attempt to try to whatever it was that the Fed misguidedly thought at the time. But in fairness to that period, credit losses were also a bigger problem. They were the problem. They were beyond a problem, by the way, because not only did they have credit losses, but you had derivatives on top of those credit losses. So it was no good. And then, wait, there was one other thing I wanted to mention. I'm probably going to be upset with myself that I forgot. Oh, yeah. There's another thing that's going around that talks about how they should have just known. They should have just known that their deposits would walk out the door. And that is something special, because if that's true, then every bank is absolutely in trouble. Okay. First Republic's been in business since 1985. They've already been through more than one cycle and more than one issue with the banks. Okay. Banks should not assume that 50% of their assets will walk out the door. That is ridiculous. You can't run a banking system that way, period. Especially when you have no credit losses, you can't run a banking system that way. So that's kind of what it is. Thank you for the compliment, Israel. Appreciate you. That is all I have. And I think I got all the questions answered. I hope that was helpful. And I hope my irritation with the markets in general didn't seem like it was directed towards anyone, because it's really not. I do actually think this is not straightforward. Let me just do one more double check. All right. Thank you guys so much for stopping by and supporting me. I appreciate you. YouTube wants me to ask all y'all to make sure that if you did want my live streams, to make sure that the subscribe button is hit and that you don't have anything in your settings that is turning me off. And I'll see you guys next time. Good luck in these markets.